Well, good morning, everyone. My name is Brennan Derone, Chief Distribution Officer for E4 Insurance Services, and you are on the BREW, building relationships every week. Today is Monday, July 6th. Hope everyone had a wonderful and happy 4th of July. On today's national days, it is both National Fried Chicken Day and National Hand Roll Day, hand roll being a type of sushi. Probably some of the most opposite entrees that I could think of, and they're together on the same day. So maybe you could get a fried chicken hand roll somewhere. So go for that. We're effectively starting the beginning of a third quarter, and I want you all to know that we are excited, here to help in any way possible. So let's crush that third quarter. With that, we have Dave Weber with Mutual of Omaha to give you a sales idea on chronic illness to help you do that. So Dave, I'm going to hand it over to you.
All right, thank you, Brandon. By the way, I'll go with the fried chicken rather than the sushi rolls. But
choice is yours.
Yeah. Again, like Brandon said, my name is Dave Weber. I'm the Life Sales Director at Mutual of Omaha. And today I wanted to talk about a chronic illness writer sales idea. We're a bit unique at Mutual of Omaha with our chronic illness writer, because I think we're one of the few carriers, if not the only carrier, that always includes that chronic illness rider, regardless of the client's age, face amount, or even rate class. So if we issue the life insurance contract, they automatically get our chronic illness rider. So I want to share an idea with you on that today. Before I get into that, I will let you know that we have two different IUL products at Mutual of Omaha. One is our Income Advantage, which is more of our LERP type cash value product, building cash for retirement. The other is what I'm going to talk about today is our Life Protection Advantage IUL. It's more of a death benefit protection product. And
Dave,
yeah,
you're getting soft and loud. I don't know if you're doing anything different with the microphone, but when you're quiet, it's hard to hear you.
Oh, okay. Well, I'll try to speak up. The product that I want to talk about today is our Life Protection Advantage. It's more of our death benefit protection IUL, and we have some unique features with that product. It is a very competitive, low-cost IUL. The death benefit goes to age 85, and regardless of how much you overfund this product, the guarantee will go no longer than age 85. But don't let that discourage you alone, because if you take a closer look and stress test our product and show it at, say, 4%, 4.5%, or 5%, it's going to carry longer at those lower interest rates than most products would. So if you're looking at a product with an age 90 guarantee, still go ahead and compare our product, because it's likely that our product will run longer at age 4% interest, 4.5%, even 5% interest than that 90 guaranteed product will run. We also include, unique to the industry, a guaranteed refund option rider. So if the market goes completely south and tanks, the insured has the option of getting 100% of their premiums back in years 20 through 25. So they've got 6 different windows where they can get 100% of their premiums back with this policy. We also include an LTC rider. Of course, there is a cost for that. It's an indemnity rider, or I'm sorry, a reimbursement rider. And as I mentioned before, we have our chronic illness rider, which is an indemnity rider. It's always included unless they choose the long-term care rider. And it's always included, again, regardless of age, face amount, or rate class. So let's dig a little bit deeper into our chronic illness rider. It pays up to $1 million or 80% of the death benefit, whichever is less. It's an annual lump sum indemnity benefit, so they can access this benefit one time per year as long as they're not meeting the 2 of the 6 ADLs. There's no upfront cost, no underwriting upfront, but there is a discount that we take at the time of claim, and I'll go over that in just a minute. So basically, with our chronic illness rider, if they never use it, they'll never pay for it. So this is an example of how our chronic illness rider works. It seems a little bit complicated the first time you look at it, but if you go over it a couple times, it's really pretty easy to explain. So in this particular example, the insured had a $500,000 death benefit. which means, as I said before, you get up to $1 million or 80%. So in this case, 80% of that death benefit is $400,000. That means they have access to up to $400,000 of their $500,000 policy for chronic illness or long-term care benefits. So with our product, they can decide at time of claim if they want $10,000, if they want $50,000, if they want $100,000. They can request all the way up to the IRS per diem, which for this year is $138,700. So in this particular example, the insured decided to request $100,000 from their chronic illness rider. They've met 2 of the 6 ADLs. What we do at that point, when they make a claim, is we get their medical records and we determine what their life expectancy is. The entire calculation is based on how long they have to live based on APS information that we receive from their doctor. So we determined in this particular case that this person had a 3-year life expectancy. So we take that times our discount factor, which we use as an example as 4.5%. If they were to access this today, it would be 3.17%. because it's based on the Moody's corporate bond rate. And we can charge no higher than 6% on that discount factor. So as an example, let's use the 4.5%. We multiply that times their current life expectancy of 3 years, and we come up with a 13.5% discount, okay? So they've got they requested $100,000. We deduct 13.5% of that, or $13,500. And each year that they access this benefit, we also charge a flat charge of $100. So you do all the math there and you come up with an acceleration amount of $86,400. We would simply send them a check for $86,400. Now, if we take a look at, let's say, for instance, they have a 10-year life expectancy. Again, we take that 10-year times the 4.5% or whatever the discount rate is at that time. So 10 times 4.5 would be 45% discount. In this particular example, we take $45,000 away from the $100,000 and send them a check for roughly $55,000. So it's going to depend on what their life expectancy is, whether or not they really want to access the benefit. But in some cases, if they've got 10 years to live, they might say, yeah, I'd like to get a check for $55,000. So what happens then is we then deduct the requested amount, the $100,000, from their death benefit and from their maximum acceleration amount. So they now have a $400,000 death benefit and a $300,000 maximum accelerated allowed. So next year, let's say that their life expectancy is 2 years. We'd multiply the 2 years times the 4.5 or 9%. And if they want to take 100,000, we'd subtract the 9,000 and send them a check for $91,000. Okay. So here's the idea. The insured has a need for $3 million of permanent coverage, and they either cannot qualify for a long-term care rider, or they just don't want to pay for a long-term care rider. So the option with Mutual of Omaha's plan is they purchase the $3 million Life Protection Advantage IUL, and this automatically includes the chronic illness rider. So they would automatically get $1 million for long-term care expenses. Again, like I said before, they either get $1 million or 80% of the death benefit, whichever is less. So obviously in this case, they get the maximum $1 million. So that's option one, but let's take a look at option two, the alternative. Again, they have a need for $3 million of permanent coverage. They can't health qualify for a long-term care rider, or again, they don't want to pay for a long-term care rider. So instead of buying one $3 million policy, they purchased, or one $3 million policy, they purchased 3 $1 million policies. Each of those policies includes the chronic illness rider, and on each of those, they have access to $800,000 or 80% of the death benefit. So now the client has access to $2.4 million of long-term care expenses versus the million that they had before. So we've got 800,000 times 3 policies. They now have access to $2.4 million for long-term care expenses. So just taking a look at that, if we split the policies, the insured has increased their chronic illness benefit from $1 $1 million to 2.4 million. The total cost of the insurance is the same because we banned this product at 1 million, so they're not paying any more in terms of cost of insurance. We've added flexibility to their plan with the what we call the GROW rider, the guaranteed refund option rider. So now that they've got 3 policies, let's say that they're 20 years down the road, they no longer have a need for $3 million of coverage. They can either cash one of those policies in for the cash accumulation value, or if the cash accumulation value hasn't met what they put into the product, they can cash that policy in and get 100% of their premiums back in years 20 through 25. So now they could use that money to maybe dump into one of the other policies, but it just gives them a lot more flexibility if they've got that GROW rider built in as well. And you don't have to write 3 separate applications for 3 $1 million policies. You can do it all on the same application. All you need to do is note in the special sections that we want 3 $1 million policies, and we can go ahead and do that for you. I know that was quick, but does anybody have any questions concerning that idea?
Feel free to unmute yourself if you have questions. But no, Dave, I like the I like the ability to have multiple policies, where a lot of carriers limit it to the aggregate of all of them, and especially that it's non-underwritten for somebody that is extremely concerned about that, gives them the leverage that they need. All right. Well, hearing no questions, I want to thank you all. Yes.
One last thing, I got a couple minutes here, and I will send you all this. We've got an additional idea that actually splits, that you can actually split the policy between one having the true long-term care rider and the other having the chronic illness rider. It creates more flexibility because the insured can actually use the long-term care rider first, and as they use that and exhaust those benefits, then they can move over to the chronic illness rider because their life expectancy is more likely to be less at that time. And this piece that I'm showing you right now explains exactly how that works. You're saving the insured money in terms of not paying for a full long-term care rider, and you're giving them more flexibility as well. So I'll send this out to you, Brendan. You can distribute to everybody that's on, but it's a nice idea where you can actually give them long-term care and chronic illness both.
And Dave, could you accelerate both at the same time?
Yeah, yes, as long as you are under the IRS per diem for the year.
Okay. Well, perfect. Well, again, thank you, Dave. Thank you all. Have a great week, and let's crush the third quarter. Stay healthy, stay safe. Talk to y'all next week.
Thanks, everybody.